Welcome back to FX Limit. Today, we're diving into the top 5 ways to analyze currency strength from a fundamental perspective. If you're trying to find which currencies are worth trading and when, this is going to be one of the most powerful videos you'll watch. Let's get straight to it. Number 1. Interest rates. Central bank interest rate decisions are one of the strongest indicators of a currency's strength. A country with higher interest rates usually attracts more foreign capital, leading to a stronger currency. Traders closely monitor central bank announcements, like those from the Federal Reserve or the European Central Bank. Rate hikes typically signal strength, while cuts can indicate weakness. Number 2. Economic indicators. Think GDP, unemployment rates, inflation, and retail sales. When a country's economy is booming, demand for its currency usually rises. One tip here: don't just look at the numbers, compare them against expectations. Sometimes a currency weakens even if the data is strong, simply because it wasn't as strong as forecasted. Markets move on surprises. Number 3. Political stability. Political uncertainty can scare off investors, leading to a drop in currency value. Elections, referendums, or even major policy changes can have an immediate impact. For example, think back to Brexit and the massive volatility in the British pound. Keeping an eye on geopolitical headlines is just as important as tracking charts. Number 4. Trade balance. A country with a trade surplus, meaning it exports more than it imports, generally has a stronger currency. That's because foreign buyers need to convert their currency into the local currency to make purchases. On the flip side, a country running a trade deficit might see pressure on its currency due to higher demand for foreign currencies. And number 5, market sentiment. Sometimes it's not about what's happening, but what traders think is happening. Risk sentiment, are investors risk on or risk off, can drive massive shifts in currency strength. In times of fear, traders may flock to safe haven currencies like the US dollar or Japanese yen. In more optimistic times, high-yield currencies like the Australian or New Zealand dollar might rally. Now here's where it gets interesting. While all of these fundamentals are powerful on their own, they work best when paired with clear trend analysis. That's where tools like the Apex Trend Indicator come in. It's designed to interpret market behavior and signal when a new trend is beginning without repainting, which is key for reliability. You could be watching a strong GDP report for the Eurozone, but if the trend is already shifting against the euro, the Apex Trend Indicator will catch it before your eyes can. It's a blend of insight and timing. For instance, after a positive jobs report, you might expect USD strength, but is the move already priced in? Are other traders already taking profit? That's when Apex's trend scanner and dashboard can give you that extra confirmation. You'll know if the trend is truly in motion or if it's stalling out. So, to sum it up, master the fundamentals, know what moves currencies, but don't rely on that alone. Use advanced tools like Apex to help you act on that knowledge with precision. Thanks for tuning in to FX Limit. If you found this valuable, give it a like, subscribe, and let us know in the comments. What's your go-to method for analyzing currency strength? Stay sharp, trade smart, and I'll catch you in the next one.